Hello and welcome to our Cytonn Report weekly segment with me, Jepkoech Kendagor. We are going to look at the Kenya-listed bank's Q3 of 2018 report, and joining me for this discussion today is Ian Kagiri, an investment analyst at Cytonn Investments. Welcome, Ian.
Thank you.
Can you briefly give us a summary of the banking sector performance in Q3 of 2018?
In Q3 of 2018, compared to Q3 of 2017, we would say that the banking sector overall had an improved performance in terms of profitability. We had the core earnings per share growing by 16.2% year on year, compared to a 9.3% decline in a similar period last year. So we would say that the banking sector has adapted relatively to the relatively tough operating environment to record an improved performance. So some of the key drivers of this performance, of course, has been, the expansion of banks' revenue lines. We did see a recovery in the interest income, the net interest income, compared to last year. We also saw an improvement in terms of the growth in non-interest income this year compared to last year, and also there was an overall improvement in terms of the efficiency of these banks. So we did see on overall the cost to income ratio improving from 59% to 56% in this year. And so this, when you combine revenue expansion and the cost reduction, ultimately profitability of the sector is going to improve.
So what are some of the key metrics that you use to gauge the performance of banks?
Now, some of the metrics that we use to gauge the performance of these banks, we have measures of profitability. One measure we use is the return on average common equity. This is simply the returns, the profit that this bank is generating from the shareholders' funds that they have been granted. And so when you compare the return on equity for this year with the last year, there was an overall improvement. Another key metric we use is the loan to deposit ratio. Simply tells us of all the deposits this bank is gathering, how much of these are being devoted towards lending. And it's also one of the metrics we use to gauge on the liquidity of this bank. Another metric we use is the net interest margin, which is an important metric when you're gauging the performance of a bank. Simply tells you how much interest income are we generating after factoring all the interest expenses we've paid to the depositors and all that. Another metric we use is to gauge the revenue diversification of this bank. How much of our revenue comes from the interest income, how much of it is non-interest. So a higher metric, of course, you would prefer because it points to a bank that is best diversified in terms of its revenue. Other market metrics we use the price to tangible book. Simply tells you the cheapness or the expensiveness of a bank relative to that true value that would be given to each shareholder. We also have the price to earnings growth ratio. The price to earnings growth ratio will tell us how cheap this bank is to purchase, how cheap the earnings are to purchase relative to the growth we expect this bank to deliver within, say, the next 5 years. So we use several metrics, and when you combine those to our own internal metrics, we have the Camel rating metric, and we also have the corporate governance metric, simply to gauge both the operational stability of the bank and also the corporate governance structure of this bank. So we use 13 metrics in total to gauge the performance of this bank, whereby we rank these banks based on how they rank when compared to the other banks. And when we sum this up, a lower score will mean that a bank that is well positioned in terms of its operational stability and corporate governance structure.
Those are great insights you've given us there about the metrics that you use. Okay. So now, from the report, we see that KCB has maintained an impressive performance of the last 2 years. Yes. So what would you attribute this to?
KCB, as you've said, has consistently ranked among the best performing banks compared to the other banks. They have been number one since full year of 2016. That's almost 2 years. And some of the key drivers of this positive performance of KCB, number one, they have a very, very strong corporate governance structure in terms of diversification, board composition, in terms of the transparency in operations. So KCB has always ranked top among the top banks or companies overall in our corporate governance score. And with a strong management and corporate governance structure, they have been able to drive the bank's growth. KCB has consistently been one of the most efficient banks in Kenya. One metric that we use to gauge the efficiency of a bank is the cost-to-income ratio, which tells us simply how much costs this bank is incurring in generating their overall income. So with a low cost-to-income ratio, it tells you that this bank is incurring less costs to generate income, and KCB has consistently ranked among the most efficient banks in Kenya. Another key driver of the banks for growth, another key driver of growth is KCB. When you compare the bank's asset base, they have a very, very large asset base. They have a well diverse and robust balance sheet. When you look at the government securities they've invested in, when you look at their loan book, it's one of the largest, in fact the largest, and that has been able to drive the bank's interest income. Furthermore, KCB has also invested heavily in terms of promoting the use of these alternative channels. We have KCB M-Pesa, we have all these manner of online and alternative banking channels. So these channels have been able to drive another source of revenue, the non-interest revenue. Then that combined with the efficiency, they've managed to successfully put a lead on costs. You did see KCB some time back having a lot of staff layoffs. You did see them reducing the number of branches they have. And these cost-cutting measures seem to be bearing fruit because KCB has been able to be more efficient. And when you combine, again, the higher income and the improved efficiency in terms of cost reduction, this has been able to drive the bank's attractiveness in terms of its operational stability, and the expectations in terms of the return on this bank's stock price going forward. This then means that it will likely continue to be the best performing bank here in Kenya.
That's really nice.
Yes.
So going forward, what should be the key focus areas for the banking sector players?
Now, for the banking sector players going forward, when you compare the performance of this year vis-a-vis the previous years, it has been an improved performance. However, in terms of the performance of the sector, one of the key things we did notice in the banking sector was the number of bad loans has continued to rise. Okay, so this typically means that when you compare the number of loans that are in a state of default compared to the overall loan book, being on a rise, it poses some risks to a bank, because in as much as in addition to increasing cost of risk costs, these are the provisioning expenses that they incur, it also poses a threat to the bank's net interest income. So a key focus going forward will be to clean up these loan books. We are likely to see banks continue adopting more stringent credit policies, meaning that there will likely be a strain in terms of credit extension, mainly to the banking sector. So focus going forward will likely be on improvement of asset quality, with banks likely adopting more stringent credit lending policies. Another key focus going forward, in the current regime of compressed interest margins, banks cannot be able to charge more than 4% above the CBR on their loans. So this is likely going to mean that a bank's interest income are likely continue being compressed by the Banking Amendment Act 2015, and so banks will continue to focus on the alternative channels of alternative banking channels. So these will likely be aimed at driving the growth of non-funded income, and continued focus on these alternative channels as well will also lead to an improvement in terms of their operational efficiency. So with more focus on these alternative channels, this is likely going to lead to lower staff demands and also lower branch count demand. So this is likely continue improving on the sector's overall efficiency. And so with improving efficiency and revenue expansion from these alternative channels, then at least we expect the growth in the banking sector to remain being sustainable.
Thank you very much, Ian, for joining us for this discussion and putting this report in perspective. We hope that you're going to join us in the new year again.
Yeah, sure.
To our viewers, thank you very much for joining us, and we wish you a Merry Christmas and a Happy New Year.